You're watching Personal Finance with Coach Kelvin. Let's get into the video. Hey guys, Coach Kelvin here. And today I want to talk to you about two one-stop shop ETFs that you can invest in and help yourself get on the path to financial independence. Now, the two ETF providers that I'm going to compare today are from Vanguard and BetaShares, and these are both listed on the ASX stock exchange here in Australia. So the two products are very much an all-in-one inclusive ETF that you can invest in and you just dollar cost average into every month, and we can expect that over the long term we're going to have very good gains because these two ETFs encapsulate a broad diversification play. Both of them have different perks and different downfalls, which we're going to go through today. Now, the first one I'm going to talk to you about is the Vanguard Diversified High Growth Index ETF, or VDHG. And this is listed on the Australian Stock Exchange. So I'm currently on the Vanguard website and I'm just going to show you a few of the key features. Now, this particular ETF has $1.01 billion of assets under management, which shows that it's a fairly large fund and it's continually growing. It was first created and came into inception on the 20th of November 2017, and it has a management expense ratio, or an MER, of 0.27%. Now that means for every $10,000 you have invested, you're going to only need to pay a fee of $27, which I think is very good. If we can expect over the long term a return of around about 8%, if we only have to pay a fee of 0.27% or $27 for every $800 of earnings, that is very good. Now, this particular fund pays its distribution quarterly, okay? So you get 4 dividends per year, and this can be set up for dividend reinvestment plans. So we're going to have a look at the fund overview. This ETF provides a low-cost access to a range of sector funds, offering broad diversification across multiple asset classes. The Growth ETF invests mainly into growth assets and is designed for investors with a high tolerance for risk who are seeking long-term capital growth. The ETF targets a 10% allocation to income assets and a 90% allocation to growth assets. So this basically is saying that 10% of the assets will be involved in cash, fixed interest and bonds, so that it's a little more predictable and balances out some of the volatility, but then the other 90% is invested into shares. Now, there is 7 ETFs held within VDHG, so it is a fund of funds, and these are all Vanguard holdings, okay, for those 7 ETFs. Now, the ticker symbol for each of those holdings are VAS, VISM, VGE, VAF, VGS, VGAD, and VBND. Now, we're going to have a look at some of the important things about this fund. So we'll come over here, we'll look at portfolio. Alright, now these are the funds and the split of the holdings, okay? So as you can see, 36.2% of the fund is the Australian shares index, 26.5% is the international index, and then the weightings get less from there. As you can see, we've got about 7% in bonds, we've got 3% in fixed interest, and that makes up the whole 100%. So there's your 10% split between income, and then the other 90% is in the growth assets. Now, if we come down even further, if we head over to performance, it's going to show you some really cool things. So obviously the fund's only new and it's only got an age of less than 4 years, but we can have a look at the 3-year returns. So since inception, in 3 years, we've earned 13.18% per annum, which is a phenomenal gain. This is also including the drop we saw in the market last year. So 13.18% is around about 5% over the historical returns of the share market over a long period of time. Now, we're obviously not able to look at it for a long period of time due to its age. However, this still gives us a return that's relatively high comparative to one single place in the world. You know, the Australian share market has returned slightly less than that in the last 3 years, so it's pretty cool that with the international exposure, that props it up a little bit. Now, we're going to have a look at our distributions. Now, if I scroll down here you're going to be able to see down here the distribution history. So for the distribution date, which was announced on the 31st of March and then paid on the 20th of April, we received 200 cents for those that invested in this fund, which is $2. Now that's a very high yield. The distribution in December was 99 cents. The distribution in September, 89 cents. The distribution in June last year, $1.25. So we're looking at a fairly high yield for this fund with a share price of only about $60, okay? Now, what I like about this is the dividends are very high in yield, but they actually are paying a little bit of capital growth, or capital gains are realized in order to pay this dividend. Now, this is because of the fact that an ETF of ETFs has to rebalance in order to achieve the goal weightings. So every time this ETF is going to pay a distribution to you, it may have sold a fund and bought another fund in order to sell what had gone up in price and buy what was lower to balance it out. Now, every time this happens, you're realizing capital gains before those dividends are paid to you. So the high yield is sort of at a cost of growth. Don't be alarmed though, because even though you may be missing out on the long-term capital gains tax discount, you are still receiving a high yield, and if you want yield, then this is a great fund to invest in. So guys, VDHG is a wonderful fund. The MER is extremely competitive, and if you look at most index funds, there's very rarely any above 0.3% per annum, and for such a well diversified and very consistent and strong fund, I think that is a very fair MER to invest in. Now, the second ETF that I wanted to go through with you today is provided by BetaShares, another company listed on the Australian Stock Exchange, and this is DHHF. As you can see here, BetaShares has said an all-in-one investment solution that provides low-cost exposure to a diversified portfolio comprising Australian, global developed and emerging market equities in a single ASX trade. So if we scroll down a little bit here, we're going to be able to see some of the great benefits. So DHHF is 100% invested in growth assets, providing an investment option growth with high potential growth. Now, what I like about this, right, if you're somebody with a long investment horizon, or you're very risk adverse and don't care about having fixed interest, this is going to have a potentially bigger upside to it than VDHG, just because the entire portfolio is invested into shares and no funds are put into fixed interest, cash or bonds. Now, it has a diversified exposure to over 8,000 equities worldwide, and the management fees are just 0.19% per annum. So that means for every $10,000 invested, using my last example, you're only paying a fee of $19. Now, again, if we were to assume that return of about 8%, so $800 return on a $10,000 investment, we're only paying $19 in fees out of that, which is amazing. That's so large. Now, there's a few more things I like about this fund, okay? So if we look down here, the assets under management, or net assets, are $51,656,866. There are currently, as I said, a 0.19% management expense ratio, and they pay quarterly dividends. So basically on par with VDHG, though slightly cheaper. Now, this fund is very cool because it automatically applies your dividend reinvestment plan for Australian and New Zealand investors. So if you're looking for a completely passive, super diversified and strong fund to invest in, where you don't really know how to set up the registrar, you're not sure how to set up DRP, this is done automatically. Of course, we still want to log in. We want to go onto the registry here, which is Link Market Services, log in using our holding identification number, lodge our tax file number, etc., so we don't pay our withholding tax of 40%. But the fact that it automatically applies DRP for you is very cool, because as you start receiving those dividends, it's automatically going to reinvest, growing your holding in this ETF. I think that's an invaluable thing, and it's the first time I've ever seen a fund automatically apply DRP for you, so it's exciting. So we're going to come down a little further. If we look here, you can see that the sector allocation is quite diverse. We've got 20% in financials, 13% in info, 11% in materials, and so forth. When we come down to country allocation, this is a little bit more balanced than the previous one I showed you with VDHG, because we have a relatively even split between Australia and United States, giving us an overall allocation of about 72% to those two. We then have the rest of the fund sort of split up between all of these other countries or economies, and then 10.9% in the other category, which is just the smaller splits which are not listed in this top 10. If we come down to performance, now this fund was only incepted on the 15th of December 2020, so it's a little early to see what the long-term returns are going to look like. However, we've seen since then a 10.18% return, and in the last 3 months, 8.61%, which is not bad considering that, it only has 6 months of age behind it. That's pretty cool. So the last thing I want to show you is the dividends. So it's still too early to see a 12-month gross dividend yield or level of franking credits. However, if you come down here, we can see that the distributions have been 1.39% and 1.45% for the last 2 distributions. Now, on a quarterly dividend, that's really cool. So we're looking at a 2.7% per annum dividend just for that 6-month period. So as we get the next 2, hopefully we're looking at around about a 5% yield. Obviously, the goal is always around 4%. So to get 5 would be even better. And this is not inclusive of franking credits, which will be interesting to see for those who are investing in Australia. Now, that's DHHF. And as you can see, this is a very diversified, a very high growth, and an extremely cool fund, and I think a wonderful one-shop stop that you can invest in. If you just dollar cost average into either of these funds every single month though, over the long term your wealth will increase. There's no doubt about that in my mind. However, always do your own research before buying into one of these. I personally don't own either of these funds. I just wanted to show you that investing can be very, very simple. You don't really need to overthink and have this analysis paralysis before purchasing. If you just want to track the market returns, get some really good dividend yield, and also aim for a diversified basket of shares or assets that balances out the volatile ride in the future, both of these are very wonderful options as they encapsulate a large broad market, a lot of holdings, and even with VDHG, multiple asset classes. Alright guys, I hope you really enjoyed this video today. I wanted to show you how simple it can be to invest in ETFs, and obviously before doing any purchasing of anything you should do your own research, but if I just show you some cool options over the time in these YouTube videos, that at least gives you some tools and some potential answers to questions that you can then do further research on before attempting to make a purchase. Remember, don't just blindly buy something when taking advice from somebody. I myself am not a financial advisor, and always make sure that you have high conviction on a purchase before buying into it. Now, if you got any value from this video, please like, share and subscribe. Leave a comment down below if you like either of these funds and which one you might be more inclined to go with if you had to choose. And guys, I really look forward to seeing you in the next video.